If you're thinking of buying right now, stop. Prices are bumping into a wall and we could be in for a pullback of 5% or more. In this video, I'll break down the key price zones to watch and when it might actually be smart to buy the dip. Let's take a look at these charts. Now, starting off here with the S&P 500, I want to highlight that this is the ninth inning of this advance. Now, before I make it sound too scary, we are looking only for a market correction right now. The idea that we're going to have another bear market is something that is a narrative going into the third quarter of the year that we are going to entertain. But right now, the way I want you to think about it is that the markets always advance like 2 steps forward, 1 step back, like waves. And what we're now at, in my opinion, at the ninth inning of this current advance, and at some point here a correction of about a 5% variety, one of these 200 to 300 S&P point corrections is imminent. While the market is measuring out a measured move up towards that 6100 area, that is also where all of the highs came in January and February and December, and so we have now approaching what are some key overhead resistance. And the key also is the fact that we have seen a momentum shift where all of that huge accelerated momentum has now normalized to that of being more of a crawl higher as opposed to any acceleration. This is at the same time as there is a huge gamma pin down at the 5900 area known as the JP Morgan whale, where there's a huge open interest of options out to the end of the month, and it's very likely to act like a magnet dropping that market. So at some stage here, we're looking for a trigger that's going to potentially begin a 200 to 300 point correction that initially can be bought on dip. And so we're not yet looking for this big opportunity to go short. It's more at this moment, there's very little asymmetry to be buying the market here. It's better to keep some cash reserves and wait it out a little bit for some sort of a short-term buying opportunity. So a lot of people that I've been talking to trying to compare this to the COVID rally, and I want to make some very distinct differences of what makes this different than that. So first of all, here is the 2020 sequence. We had this 20 to 30% market correction that happened in about a month. It was a vicious market decline. For instance, the NASDAQ in this current crash was down around 26, 27%. This was about a 35% correction. And then we had that violent rally to the upside, the snapback rally that many people are comparing to today, suggesting that after that, you can see how the bull market just continued to roar higher, and we saw off of those lows the S&P 500 double in its value. And so what we're looking for at this stage is this going to be a deja vu, or is this the beginning of a new bull phase? And I simply don't think so. Why? What is fundamentally different? Well, back then when COVID happened, they force shut down everything in the markets, and to re-stimulate the economy, we saw one of the greatest fiscal stimuluses as well as monetary stimuluses and credit expansions that we pretty much have seen in history. As an example, I'm just going to use the money supply chart as a way of actually demonstrating this. You can observe here between 2010 to 2020, we saw money supply increase from 8 trillion to about 15 trillion. Let's call it a doubling of money supply over 10 years. But we saw in the post-COVID period, money supply expand from $15 trillion to $22 trillion, a 50% increase in just a year and a half. This kind of this credit expansion, money supply expansion, fiscal stimulus expansion drove a huge inflation, a huge stimulus, expansion of corporate earnings, and all of the things that drove that bull market. We today are seeing almost no real credit expansion. In fact, the Fed is staying too tight. Trump is calling Powell too late Powell because he's not providing stimulus into the economy. They're trying to pass these fiscal budget spends, but in the end, there is not the environment for this big stimulus to come in. So comparing this to COVID is, I think, quite incorrect. Now, I feel that there's going to be substantial resistance up here on these markets, up along these higher levels, and that's not going away. Now, what else is it that could cause this market correction? Well, I'm just speculating here on the idea that the bond markets are going to be where a lot of ruckus could happen. Particularly, I want to focus here for a moment on the 30-year yield. And what we're witnessing is that we are on the long bond, we are trading up along the 2023 highs, where the bear market of the in bonds stopped, but during the 2022 massacre and that ended in that 2023 starting window. The point here is that we are now back to a level in a bull flagging formation that could send yield to multi-decade highs on the 30-year bond. Now, the 10-year yield, which is very important to the U.S. economy for everything from mortgage rates to all sorts of other metrics, is not been as fragile, and we're still trading more or less around the 4.5% level. But if the long bond starts, the yields start to rip, and the 10-year yield starts pressing towards 5%, at some point the markets are going to start to care, because that is going to seize up the credit markets and actually slow the economy. And this could end up being the catalyst. So watching that 30-year yield continues to be one of the more interesting things. At this stage, hold off on many new investments in the S&P 500. Let's see where the correction goes, and then we'll call it from there.